Derek Jones here, folks, Director of EOS Property Group. Got another in our roadmap series, and this one's going to specifically focus on the area of finance, but we'll also delve into a little bit of tax issues, into some tax issues that might help you along your journey. Because we often come across this notion that, and you often hear it and read it and all that sort of stuff about, look, for matters for finance, matters of accountancy, go and see an expert. How do you know the person that you're speaking to is an expert? But before we get much, and that's what tonight's all about, or this presentation is all about. It's about giving you a bit of background information so that you can engage with your qualified advisor, because the information I'm going to give to you during the course of this presentation, I'm not qualified to talk accountancy or tax matters, and nor am I qualified to talk financial borrowings and those sort of things. But what I'm giving you today is a background of information, a scaffold of information, if you like, that when you go and speak to your broker or to your accountant, that you can get a feel for them and their capacity. I've been doing this property stuff now for nigh on 13 years. And one of the common issues that we've come up with is that there are a number of really successful accountants and brokers out there, but then there are some that should be doing something else, to be quite frank. So that's what today is about, or this presentation is about rather. It's about trying to give you a scaffold so that you can have a really good conversation with your broker and or accountant. Now, we're not doing a webinar here. So this is the stuff that we're going to take you through today. We're going to talk about some of the definitions that we get, see attached to the finance world. We're going to talk a bit about some loan structuring stuff and the way I've gone on a personal level. We're going to talk about, paying off your home. Is that a good thing or a bad thing? Lines of credit and some of the things that you need to watch out for there. What to do if you receive a windfall, whether that be a garage sale that made $2,000 or a lotto winning that made $2 million sort of stuff. There are some good strategies that you can use for those little windfalls that you do in fact get. Going to maybe give you a bit of a different approach to debt reduction that may actually tickle your fancy. Buying off the plan, I'm going to talk a bit about the financial issues associated with that and some of the dangers as well, by the way. I'm going to talk about lender's mortgage insurance, because that's one that's often a hotly debated topic. Is it a good thing or is it a bad thing? So we'll talk about some of the pluses and minuses there and let you make that decision. And then the last one we're going to talk about is very much in the realms of accountancy or tax type issues. And it's to discuss what's a repair and what's a renovation, because those two items of property upkeep, if you like, are certainly treated very, very differently by the ATO. So some of the core definitions we're going to go through today, or initially, are equity, because we're going to use these during the course of the presentation. So if you've got a good handle on what they mean, then the rest of the presentation should make a little bit more sense. We're going to talk about the notion of available equity or accessible equity. Talk about cross-collateralisation loan structures and how you can know if in fact loans are cross-collateralised, lines of credit and redraw. So let's start by initially starting at the beginning, which is a great place to start, as they often say in the classics. We often hear people talk about this thing called equity. Well, what is it? So let's get our head around it first. Equity is quite purely and simply, it's the difference between the value of your property and any liabilities or loans that you have secured by that property. So it's just a straight out subtraction sum. So we find out what your property is worth, and look, you don't have to use a valuer, but you know yourself roughly what your home is worth. From that figure, we take off any loans that are secured. So it might be more than just your core loan. You might have lines of credit that are secured by your own home, so they need to come into that equation. So let's say your total secured loans secured by your own home are $100,000. That means you have equity of $400,000. Right? Straight out math sum. But the key thing is you cannot use all of that $400,000, which then gets into our next definition. What is available or accessible equity? So I'm going to use 80% here, but some of you may be able to go to 90 in terms of increasing your total loans, or your available equity rather. But for the purposes of this discussion, we're just going to keep it to 80% and keep the issue of lender's mortgage insurance off the table for now. So we go back to the previous home. The home is obviously still worth $500,000. What's 80% of that? 80% of 500 is $400,000. Take off or take away any loans that are secured by that gives us a figure of available equity, $300,000. Now that's a very simplistic way of looking at it, because some of that you might have a redraw facility, you might have been paying off your home loan very aggressively, and you might be well ahead of schedule. So that $100,000 may in fact be a little bit more than that. And similarly with your line of credit, even though it may never have been used, and you might think, well, that's a zero balance. No, in fact, what the bank will do is look at what is the limit on your line of credit and not, in fact, what you've spent. Because there's nothing to stop you tomorrow going out and spending the balance of your line of credit, and all of a sudden you've taken your total debt level above that 80% mark. So you've breached that 80% level, and therefore your available equity level will come down a little bit further. Next thing we're going to look at is this notion of what is a cross-collateralised loan. And once again, this is I guess a point of discussion. It's a bone of contention, if you like. Is it a good thing or is it a bad thing? And most brokers that I speak to suggest that it's not desirable. But having said that, there may well be times you don't have many options. So think about it that way. But by and large, how do you know if you're being offered a cross-collateralised loan, or in fact your current loan structure is cross-collateralised? Look, the easiest way is obviously to talk to your broker or your bank. That's one way. The other way that you can do it is to go back through your loan documents. You know, that wad of papers you got when you first got your loan approved, and then the conditions came out. If in that, buried in that document somewhere, it makes reference to more than one property title, what that means is the bank is using the equity from those two properties to secure that one loan. So that's the clearest way of determining whether or not your loans are cross-collateralised. So if you see two property addresses on your loan documents, it's highly likely you've got a cross-collateralised loan. What are the advantages? Look, the advantages by and large reside with the bank. Okay, it's very much easier for them because they're only processing another single loan, and it means too that the bank has tied you up in a bundle that is more about looking after the bank and its interests rather than looking after you and your investment interests. So the banks by and large will try and cross-collateralise you, but if you can, steer clear of that under any stretch, any hook by means that you can be uncross-collateralised, that is to your advantage. It may be useful though if your equity level is quite limited. So that's something that you can talk to your bank about. Look, the disadvantages are you have minimal control over your funds. Okay, so in other words, if you've got two properties, they're cross-collateralised, you sell one of them, the bank's highly likely they're going to come in and take a large chunk of those profits from the sale of that first profit and use to pay down any remaining debt. Now that can be obviated, if you like. You can alleviate or prevent that from happening by doing what's called a partial release of funds. Now you need to talk to your broker about how that can work, but it means if you can do a partial release of funds, it means that should you sell one or more of your properties, that you can control the outcome of where those surplus funds go. Okay, so that's something that you really need to do if in fact you're looking or considering or have got a property on the market and there's a cross-collateralised loan obligation in place there somewhere. The other one, and this is more so for people who are buying off the plan, but if you buy off the plan and you've got a cross-collateralised loan, it's very easy for a bank or a lender to hide a potential low valuation on your purchased property. Okay, because the extra equity needed to secure that property can be taken out or bumped up out of your own home. So think about that one as well. You want to try and maximise or put yourself in a position where your loan position is to your advantage and not to the bank's. Okay. Now the other one, of course, is if you are cross-collateralised, then your lending opportunities are very much restrained and confined to that one particular lender. Unless you break something off and take the titles to that to another lender, by and large you're going to be constricted or constrained to your one lender. And that also can be a significant disadvantage too, because the lenders have different ways in which they assess your income. And it may well be that your favoured or preferred bank at this point in time may well be the bank that is not prepared. You may find there's another bank that will lend you more money. So keep the options on the table, and that's why it's usually to your advantage to spread your lending risk around amongst a few lenders anyway. So the key things to look for here is there's generally a mortgage over 2 properties, and typically the number of loans will equal the number of properties. Now that's a very broad brush statement, but it gives you some clues and cues so that you can now go start looking through your paperwork and trying to determine what loan structure you've got here. Now the next one is it's a line of credit type structure, and it's commonly used, and some people say, well, yeah, but the lines of credit cost you a little bit more money. And look, the increment in lines of credit interest rates is quite negligible, especially when you stack it up against the advantages you get from having a line of credit type structure. And I'll put on the table, I'm a line of credit type structure person, okay? So it looks like this. So you've got your own home here, you've got plenty of equity in here, so you go off to your broker and your bank and say, look, I'd like to set up a line of credit, that's this symbol here that we're using, secured by your own home. Now potentially you can take that line of credit and use the balance of your available equity. Okay, so that's what you can potentially go to. Now we need to talk that through, and we'll come back to that point in a minute. And that then gives you maximum flexibility of funds. For example, you can take from your line of credit enough funds to go and buy your new Land Cruiser 200 series. Not that I'm advocating that, by the way, and far from it. It means then you can go and buy some shares, you can put it as a deposit on an investment property, you can buy a round the world trip or whatever it is. Can I suggest to you very, very strongly that if you're going to set up a line of credit type facility, that it is strictly speaking for investment type purchases only. Okay, so it gives you that flexibility of use of funds because you've already been approved that money. It's theirs for you to use as you see fit. So the security level you've now put on the table is basically your own home, which secures your core mortgage on that and this additional line of credit. Now, there are some disadvantages because there's no cut and dried answer here. Sometimes there are slightly higher interest rates, and as I said at the outset, the difference is quite negligible. You know, we're talking 0.1, maybe 0.2%, and in some cases probably no difference at all. But you've got to understand that, okay? The other big disadvantage is what I alluded to a couple of seconds ago. It is very, very attractive to spenders. And you see stories of people who get their lines of credit and then go and buy the round-the-world holiday, and they go and buy the new car, they go and put the new kitchen in, they go and do this, they spend that money on consumables. You've got to remember a line of credit, think of it like a big credit card, okay? Certainly the interest rate is much, much lower, but you need to start paying it back at some stage in the future, so don't be blowing it all on consumable items. Now the other key point is that when you set up a line of credit, because at that point in time, that line of credit is not attached to any new investment property or new investments that are going to be earning you an income. So your ability to service that loan and future loans can be somewhat compromised because your line of credit does not have an income earning aspect to it that is attached to the line. So what do I mean by that? So if you go and buy an investment property, when the bank assesses you, they will project forward and estimate what sort of rental income that property is going to earn you. And that perceived or real income, rental income, then gets added to your income levels to help you service the loan. With a line of credit, that doesn't happen. You've set up a line of credit, but at that point in time, there's no additional income earnings or potential earnings attached to it. So your net income hasn't increased on one hand, but your debt level does increase. So it can be a little bit counterproductive, if you like, in terms of your overall borrowing strategy. And that's where it's really, really important to talk to your broker about this line of credit, how it fits into the long-term plans that he or she has and you have, to make sure that they're, that the swings and roundabouts is working to your advantage, if you like. Okay, the other key point is that once you've got your line of credit set up, it's very easy to then go to another bank and say, hey, here's my deposit, which is money taken from your line of credit. I want to go and buy this property. Can you give me the balance of the loan, or the core loan, secured by that new investment property only? And that's a very easy structure to set up. So from my perspective, a line of credit has a number of advantages, and I'd recommend that you go down that line of talking to your broker and investigate, setting that up before you move much further. All right, so that's a line of credit. Another one which is similar but different is this notion of a redraw. First of all, what is a redraw? Okay, most of us, we've got this thing in the back of our heads where we've got to pay off our home as quickly as we can, and we get ahead of our repayment schedule. And you'll see it on your statement. It says balance, loan balance $85,000, limit $185,000. So that means in that particular scenario, someone is $100,000 ahead of schedule. Now, if you are ahead of schedule, it's possible that you can then redraw that $100,000 that I just spoke about. It's very easy. There's no paperwork on your part. The problem is that you've then mixed in one loan some potential investment interest bill and some non-investment interest bill. And that can become quite problematic as you move forward down your property journey. So strictly speaking, you're far better off, and it does take a bit of paperwork, is going to speak to your broker and say, look, what I want to do is to split that off. Now, some banks will basically do it very, very easily. Some banks will need you to do a full reassessment. Show us your income, show us your assets, show us your liabilities, and go through that process. So that's something to think about. But the potential for mixed debt is very, very significant and quite severe. So if you have got some funds in a redraw and you're thinking, I can grab the 50 grand or the 100 grand or whatever it happens to be from my redraw facility, can I say stop right there, talk to your accountant, talk to your broker first, and investigate the possibility of splitting it up before you do anything. Absolutely critical. Okay. So let's now look at this notion of maximising your borrowing potential. So, okay. And how do you do that? Okay, look, purely and simply, you can obviously get in the car, jump on your bike, walk the streets and go and see any number of banks if you like. Okay? And we've all got the capacity to do that. The problem is that you're then going to spend a lot of your time speaking to a number of bank managers, and with all due respects to you and them, probably wasting their time. So what I advocate to anybody who's listening to this webinar, this presentation, is to grab yourself a really, really good broker, because they will ask you a series of questions and they will know from the information that you have provided them with which bank is most likely to suit your circumstances, which one is likely to maximise your borrowing. And that's fundamentally what it's about. It's about you being in a position to borrow as much as you need so that you can start or continue your investment journey. And that's what it's all about. At the same time, you need to talk to your broker and or bank about minimising your collateral or the security that you've provided. Okay? Now, by and large, a bank will try and maximise their security position. In other words, reduce their risk exposure to you. So therefore, I'm actively encouraging you to go and speak to a broker so you can talk about keeping the amount of security that you put on the table to an absolute minimum, because that then helps you in terms of you moving forward. Now, the other thing too, and part and parcel of that, is for you to keep maximum flexibility of your funds. So you don't want to tie yourself up in knots so that the bank is the greatest control over how and where you use your funds. You want to be able to do that, make those decisions in consultation with your broker and your accountant so that you can influence the journey that you want to be on. So to me, they are the three key points when you're looking at borrowing money. And the bottom line is make sure that you use a broker because they can do this work for you day in, day out. Now, whilst I'm talking about finding out how much you can borrow and all that sort of stuff, can I say to you and be quite explicit about this, do not get a pre-approval done unless you are seriously looking at buying. Because if you have a number of pre-approvals out and about with 4 or 5 or 6 different banks, they all get put on your credit check. So when a bank does a credit check and they say, well, hang on, you've had 6 pre-approvals and none of them have come to fruition, they start looking at you a little bit closer, right? And they may actually use that as a reason to reject your borrowings or your loan. So don't do a pre-approval unless you're really, really serious about buying something, okay? That's it, and I can't stress that enough. Now, the last point I want to talk to you about is this notion of interest rates. And look, interest rates, they're just the cost of doing business. And the reason I say it like that is because I've seen people chase interest rates and they can get a 0.1 or a 0.05 less over here. But by going to that lending institution, they may then have reduced their potential to borrow money because the bank over here might have had more favourable lending policies and was prepared to give an extra couple of $100,000. And you might think that that's not possible. Can I assure you that it is entirely possible? I've seen assessments come back, from a couple, same income, same number of kids, same credit cards, same loans, same everything, and it's been sent, a broker's done the numbers for us, and it's come back, and the difference between the big four, the difference between the bank that was prepared to lend the least and the bank that was prepared to lend the most at that point in time was about $200,000. So that's a significant difference to your plans if you're with the least favourable borrower versus the most favourable lender. So interest rates should not be your primary consideration. That's just a byproduct of that discussion that you'll have with your broker. So that's the point. Use a broker to help you along the way. So effective loan structuring, I've talked about that line of credit facility. So it looks a bit like this. Okay, so there's our home. We've set up our line of credit facility. From that, then we go and find ourselves an investment property. Now, I would tend to recommend or suggest that you talk to your broker about having that line of credit facility in place first. But having said that, and your broker is the one that is best placed to advise you, of course, it may be that can be done the same time you take out your loan for this property here. So we've set ourselves up with our line of credit. We then go and find ourselves an investment property that we want to buy. And the deposit and costs, purchasing costs, stamp duty, those sort of things, can all come from your line of credit. And then the core loan is provided by the same or different bank, depending on what your broker determines. So that's how it works. So at the end of the result it looks like this. So you've got one core loan here against your home. You've got a second core loan here against your investment property. And over here, you've got a line of credit from which you've taken your stamp duty and your purchasing costs and deposit. So that to me is a very, very fluid, effective loan structure. But look, talk to your broker about it because he or she will be able to say that's going to work for you or it's not going to work for you, as the case may be. Right? It just then means too that if there's, depending on the size of this line of credit over here, you may be able to add a third property here and grab your stamp duty, your deposit and costs from here and keep the journey going that way. Look, that's where your broker is going to really earn their money. It's about loan structuring. Okay, moving on to the next point. A great many of us want to pay off our home ahead of schedule, and that does set you up so well. And if you can do that, fantastic. But there's a but here too. If it's likely that the home that you're currently living in is not going to be your home forever, and that in some point in time in the future you may actually want to turn it into an investment property, then maybe paying off your own home is not necessarily the best thing for you. And this is where you've got to have a really good conversation with your accountant, okay? And I'll explain it like this. Let's say that the place that you're currently living in, maybe you have a couple extra kids, maybe the kids leave home, maybe there's a work transfer involved, maybe there's a family breakup, maybe there's a career change entirely. Who knows? Okay, but those sort of things, those sort of events in your life could result in you moving from your existing home and then going to go and buy another home somewhere else. Now the problem is, and that's fine, the problem arises is that if you then want to borrow some additional money to buy your new home in your new destination, and you want to turn your existing home into an investment property, and you think, well, I can refinance my existing home and take all of that money and buy my new home, so I've got a lower level of debt on my new home and a higher level of debt on my existing home. I just repeat that. So you've refinanced your existing home, taken all that money to go and buy a new home in your new destination, with an end result that you've got a low level of debt on your new home and a high level of debt on your old home that is now an investment property. And you do that thinking that the loan on your now investment property is all tax deductible. Unfortunately, it is not. And I'll repeat that. Unfortunately, it is not. Because what the tax office will look at is says, well, why did you borrow these additional funds? Well, those funds were borrowed to go and buy a home. So the purpose of the loan was not investment related. It was of a private nature, so therefore it is not tax deductible. So think about that. So if there is a possibility, so there we go. So if you do that refinance things, you get yourself in a bit of a rocky place, okay? So talk to your accountant and broker about that. The other option is to sell up. Now, I know people say, well, yeah, you're going to lose some money in agents' fees and stamp duty buying the new one. Well, you're going to pay stamp duty on the new one anyway. But the key thing is here that by selling your own home, highly likely there's no capital gains tax on it. In a few cases there may be, but highly likely there's little or no capital gains tax on it. So you can take the net profits from that sale and lump them on your new home. Certainly it means then if you wanted to invest at the same time, you've got to go and buy another investment property. And there's costs there, stamp duties, stuff like that as well. But at least your loan structure is very clear. It may be possible that in some states you can sell to your partner. Okay? And some states you can do that without having to pay stamp duty. But that's something to talk to your accountant, solicitors about as well. But just bear in mind too that there may be some tax implications. If the ATO investigates that transaction and says, well, you only did it to save tax, well, then you may be pinged under section part 4, I think it is, in the Tax Act, which talks about tax avoidance. Now, so what do? We'll go back a step. So how do you avoid this sort of thing? You know, this refinancing or, you know, wanting to buy a new home. What you can be doing is instead of pouring all your surplus money into your mortgage directly, you can be pouring it into an offset account. Okay, so you pour all your excess wages, your profits, all those, your lotto winnings, inheritances, those sort of things into an offset account that's linked to your own home. So it means that when you then go and find your new place to live, you can take the money out of your offset account and use it as a deposit on your new home. And that is perfectly legitimate from a tax point of view. Okay. Now, whilst you're ploughing money into your offset account, what you're doing is you're reducing your monthly interest bill on your own home. Okay, so that's actually helping with your cash flow as well. Okay, so that's if there's a possibility that you'll be moving out of your current home at the moment that you live in and moving somewhere else, talk to your broker and or accountant about the advantages of an offset account. Okay, very good strategy. The line of credit stuff. And probably if we go back 8-10 years, I guess, You would have all remembered the ads that were on telly, the guys with the latest Holden Utes and the HSVs and the round the world trip, and they're talking about, well, how did you afford that car? Equity, mate. Remember those ads? I think it was Commonwealth Bank. But it can be dangerous, okay, on a number of fronts. First of all, a line of credit is just like a credit card. So if you have bought a round the world trip or a new car, in effect what you're doing is you're buying it using a credit card. Okay, sure, the interest rates are lower, but the implications are the same. You're buying a depreciating item, a consumable item, using borrowed funds. All right, so that there are issues associated with that. The other issue with a line of credit is that if you've set it up for investment purposes and you only use it for investment purposes, it means that the interest incurred in that account is all fully tax deductible. If, however, from that line of credit you use some money for investment purposes and you use some money for personal consumable items, you've suddenly got a situation where you've mixed up personal and investment expenses. Now, as a one-off event, you can manage that because you might have spent 40 grand on investment, 40 grand on a new car, so the interest that accrues in that line of credit is split 50-50 between deductible and non-deductible debt. So that's pretty straightforward. The problem arises when you might be buying your groceries out of that line of credit, or you might be paying car repairs, your power bills, your phone bills, and then ploughing it back in with your own income and those sort of things. A revolving line of credit that so many people talk about. That then makes this notion of personal and investment expenses really, really difficult to calculate. And I've seen situations where one person estimated that about half of their line of credit was tax deductible. When the accountant got the calculator out, it turned out that only 3% of it was tax deductible. So if you're going to be going down, if there's a possibility that you're going to use your line of credit for personal expenses, set up two lines of credit. So you can clearly differentiate between what's investment and what's personal and what's deductible and what's not. The other issue too becomes is, well, I'm going to go and buy this car this week because I know I've got an inheritance coming in from Auntie Joan next week, and I'll be able to use that $40,000 to wipe out the $40,000 I've used to buy the car. And then the rest is all deductible. It doesn't work like that, unfortunately. What happens is the ATO says, well, that 40 grand you've paid into your line of credit means that you've reduced your overall debt by $40,000, but your mixture still remains. So you're still a 50-50 proportioning thing there. So that's why if there's at all a possibility that you can mix personal and investment debt, split your lines of credit. Okay, and that's what we just talked about there. So that's the line of credit stuff. Okay, what should you do if you receive a lump sum windfall? Well, there are a number of options, and I'm really big on maintaining flexibility of funds. So you need to look at your situation and talk to your accountant and broker about this too before you actually put any money anywhere. I'd be trying to maximise your non-deductible debt. Okay, so maybe you've got a car loan, so that might be a good place for it. Maybe you've got a credit card, those sorts of things. Or the other thing that you may want to do is plough it into an offset account so that you maintain access to it. You might be saving up for something, kitchen extensions, renovations, whatever. So by ploughing your money into an offset account linked to your own home or to a loan somewhere, it means you maintain flexibility or access to those funds, and at the same time you've reduced your interest bill on the linked loan. So if you've linked your offset account to your home loan, whilst you've got those funds in that offset account, it means your monthly interest bill on your home loan, it reduces. And then when you get to your savings target, you can take that money and use it for whatever you need, and it's nice and clean, and there are no issues for you to consider. So that's where an offset account really comes into its own. And I guess looking at that notion of tackling debts, and most of us are very, very familiar with, the one where you start, the strategy where you start with your highest your highest interest bill. Typically that's your credit card type thing. It may well be that there's another strategy and that you hadn't considered. You might find that you've got a number of small debts. And one strategy I've seen people use and employ quite effectively is that they start with the smallest debt, irrespective of what the interest bill is. So they tackle their smallest debt first. And the reason they tackle their smallest debt first is because finding that spare cash can sometimes be a little bit easier if the debt level is less. So they plough all of that spare cash into their smallest debt. As soon as that's paid off, they cancel that out, and then they repeat the process. So let's say they're paying off $200 a month into that particular account, and if they found another $100 a month, so in total they're paying off $300 a month. They then now target the next loan or next debt that they've got, and they pay that $300 that they've now created as a spare and use that to target their next debt. So it's $300 plus whatever they were previously paying, and then they bring that debt down. So they're cascading their money up the chain. So, and that way there's forward momentum. They now look at it and say, well, I've paid that one off, I'm now working on that one, and then I've got one more to go. So that's one way of tackling it. Of course, the other way is you do start with your highest interest bill, so typically your credit card, and you plough all of your spare cash into that, get it down to a zero balance, but you repeat the process in reverse. So if you're paying into your credit card $500 a month, get that back to a zero balance. Now you take the $500 a month and plough it into your next debt, and so on. So you then strategically tackle your debts so you can see some forward progress in your overall debt position. Okay, so there's two ways that you can tackle it. And of course, the bottom line should always be, of your two types of debt, non-deductible or deductible, the one you should tackle first is your non-deductible. Okay, because that's the one that you're doing by yourself. Right? The deductible stuff, you get help from the ATO, all right, and maybe a tenant or something like that. The non-deductible stuff, you're on your own. All right, so always start with your non-deductible debt, but then look at that. Do I start with the lowest debt first or the highest interest rate first? And you can work that out by yourself or in consultation with your accountant or broker. Okay, the next one, we're going to change tack slightly here. We're going to look at the notion of buying off the plan. And there are a number of people out there who think it's a great strategy. And there are a number of people out there who wish that they'd never touched it with a barge pole. Okay, basically buying off the plan. And what am I saying when I say off the plan? I mean something that is you cannot get unconditional loans for. So it's 3 or more months from completion, pretty much. It's not a finished product. That's basically what we're saying. So what do you need to look out for? Well, clearly, if it's an off-the-plan product, it's highly likely there's a number of them going up, and it's highly likely that there are a number of those properties that are going to finish and settle at or about the same time. So you are going to have issues trying to attract tenants because it'll be a bit of a Rafferty's rules and a potluck, a bit of a lottery to find out who gets into, whose properties get tenanted up first. And it could well be that you actually turn into a reverse bidding war to find yourself getting tenants moving into that place. So think about that, okay? But bigger picture beyond that is what else is being built in the area. It's no good having a complex of a couple of hundred units, for example, and then directly over the corner or down the street there's another complex going up with 400 units. Or a significant number of properties, whatever they happen to be, because that flooding of the market or possible flooding of the market is going to have an adverse effect on your rent returns and highly likely the valuations that you may gain for your property, because your valuations are going to be very much tied in with the performance of the market around you. So if you're in a high-rise building, the best you're going to do is the best selling price that's in the building at that particular point in time. right? So there's not a lot you can do. You can't paint, you can't renovate, you can't do anything to increase the value of your rent returns because it's very much tied in, the performance of your property is very much tied into the performance of every other unit in that building or neighbouring ones. Okay, so you've got to look at the supply issue and the potential oversupply that may occur sometime into the future. The other one, and this is probably by far and away the scariest issue attached to off-the-plan properties, and it relates to finance. So you go and find a unit 2 years from completion. You sign the contract, get your solicitor to look at it. It's your solicitor, not their solicitor. Your solicitor said, yeah, look, it's fine, no drama. Part of your contract will be a requirement for you to go unconditional within 2, 6, 8 weeks, whatever it happens to be. So you go through that getting finance approved process. The problem is your property is nowhere near finished. Now the best the bank will do for you, they won't give you unconditional finance because they need to see strata title plans, they need to see folio numbers and all that sort of stuff before they need to value the property, so they need to see it completed. So the bank will not go unconditional until right at the end of the building project. So you're saying, well, hang on, I've got to be unconditional finance back here in week 6. The property's not finished for another 18 months. So there's a huge time lag between when you have to go unconditional and when you actually go unconditional as far as the bank is concerned. Now, it may well be right back at the beginning your bank has given you conditional approval. Notice I said conditional, not unconditional approval. And what the bank is saying is, yeah, look, we're prepared to give you the money on the basis of the information you've provided to date, but we will be reassessing your income, we will be doing a valuation later, and we will need to see all those folio numbers and so on. Now, it could well be, and at the same time, you've got the vendor saying, hey, you've got to go unconditional, otherwise you're going to lose this property, So you're caught between a rock and a hard place. If you go unconditional now, it doesn't actually mean you've got the money when you need it in 18 months' time. And also it means that you're now locked into a building product contract because you have told the vendor that, yes, I can afford this property. So be very, very aware of going unconditional when in fact you haven't got unconditional finance. Because a number of things may happen. You may find that the market changes significantly and the valuation of the property is not worth $450 that you're paying, it may be $400. So there's a $50,000 shortfall that you have to make up from your own resources. Secondly, you may find that you're laid off. Your income changes significantly for the worst. The bank reassesses you. Hey, yes, we said we'd give you the funds 18 months ago. You've now lost your job. We're not going to give you the money anymore, but your contract is unconditional. So there are a number of potential pitfalls if you are buying off the plan. Make sure, please, 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 that you talk to the broker about those. Ask them, is this finance approval that I've got from you or the bank, is that unconditional? Because it puts you very much, as I say, between a rock and a hard place. The other thing too that I notice often with off-the-plan projects is that their cash flows are very, very ambitious. In other words, they tend to underestimate the body corporate costs, and secondly, they also overestimate the likely rental income. The difficulty with that, of course, is that you make an investment decision based on ambitious cash flow projections, and that looks quite attractive. But when the rubber hits the road in 18 months' time, they may find, oh, gee, well, the rents are not going to be like that, particularly at the beginning when all of your properties are finished at one time. You might take a $50 per week hit in your back pocket. The other thing that might happen after a couple of years, they say, well, actually, no, those strata projections that we had, they're not actually giving us sufficient money to work with, so we now need to increase your strata contribution, and sometimes quite significantly so. So bear those in mind when you're looking at off-the-plan property. The next one, and this is a real hot topic in debate, lender's mortgage insurance. First of all, what is it? Look, typically in most instances we talk about people borrowing 80% of the purchase price of the property. What does that mean? $500,000 property, 80% of that is $400,000. So they borrow $400,000 and come up with the other 100 plus purchasing costs from a line of credit or cash or wherever it happens to be. That core loan, $400,000, 80% is often the ceiling that people talk about. But in fact, you can go over the 80%. And this is a great conversation to have with you, particularly with your broker. Now, there is a cost involved, and that's where lender's mortgage insurance comes in. If you go over that 80%, and some banks it might be 85, but we're just going to use 80 for purpose of this discussion, you'll then move into lender's mortgage insurance territory. And what is that? The bank will go to an insurance company and say, because we're carrying more risk on this, we're lending up to say 90%, we want you as the borrower to pay an insurance premium on this loan. Now the premium as itself is only a one-off cost. Typically it's about 2% of your total borrowing. So if you borrowed, in the previous example, $500,000 property, and instead of borrowing $400,000, you borrowed $450,000, 2% of that is $9,000. So that would be roughly what your lender's mortgage insurance premium will be. Now, the 2% is a very rough figure. Folks, I've got to explain that to you, because it does vary according to that percentage, 90, 95, it gets higher. And also it is varied according to your total borrowings and your total exposures. All right, so the 2% I'm talking about here is not hard and fast, but it's a very much indicative figure to give you, so I can run some examples and samples to show you how it works. But whatever that figure happens to be, it is tax deductible over 5 years or the life of the loan, whichever comes sooner. All right, so it's not a cost that you wear all by yourself, and it is a one-off cost, as I did say. So let's see how it looks. Let's assume you're in that I don't want to pay lender's mortgage insurance camp, and look, that's fine. And let's assume that you've got $100,000 funds in line of credit or wherever, okay? And you find yourself a property worth $300,000. If you go to 80%, that's $240,000 loan. Your deposit is $60,000. We need about $15,000 for stamp duty and those sorts of things. So your total contribution here is $75,000. And that leaves you $25,000 unspent. Okay. The next person is quite happy to pay lender's mortgage insurance, and as I said previously, I've used roughly 2% as an indicative figure. We find our property. This time we need a $30,000 deposit, so that reduces by half. Our costs, stamp duty and things like that, remain the same. And it's roughly $5,000 lender's mortgage insurance. Okay, now it's actually probably a little bit more than that. So this is very much an illustrative example. But that allows us to buy one property. So this person who's now paying lender's mortgage insurance then says, well, hang on, looks, that's cost me $50,000. I've still got $50,000 left in my line of credit. Okay, $50,000 here. 5 plus 15 is 20 plus 30 is 50. I'm going to go again. $30,000 deposit, $15,000 cost, $5,000 lender's mortgage insurance. There I've spent the remaining $100,000, the remainder of my $100,000, and I've now got a second property. So that's the difference lender's mortgage insurance can make in some situations. So as I say, talk to your broker about this sort of stuff. The difference is that you've now got, and let's put these side by side, the person who didn't want to pay lender's mortgage insurance has assets worth $300, still got unused funds of $25, and I think that's a good thing. 10 years time, we're just using 10 years to double to illustrate the point. The assets worth $600, then $1.2 mil, then $2.4 mil. Okay, fine. Person over here who is happy to spend lender's mortgage insurance has an asset worth $600,000. Their bill, lender's mortgage insurance, was 10 grand. Okay, probably a little bit more, but it gets the point. No funds left over, okay, here. But now if their properties double every 10 years, 1.2, 2.4, 4.8. So double the amount in asset value, doubles the amount of profit you make at the end of the journey, whenever that happens to be. Okay, so that's the advantage of using lender's mortgage insurance. So talk to your broker about that. Now, a good broker should talk to you about this sort of stuff. All right, so if they don't initiate that conversation, then you should do it yourself. Okay, last, almost at the end here, what's a repair, what's a renovation? Okay, purely and simply, I'll give you a couple of examples and then classify them. Storm comes through tomorrow, okay, flattens three of the fence panels in the backyard, or a tree falls on them, or white ants eat out the posts and 3 panels fall over. Repairing that fence is replacing those 3 panels and any posts only. Okay, so I lost 3 panels for whatever reason. I've put 3 panels up. That's a repair, provided you use the same sort of material. Okay, so it's not about replacing wooden pickets with colour bond sheeting. That's a renovation. A renovation is exactly as I said, replacing wood with colour bond. The other renovation could be, well, gee, that fence looks a bit dodgy anyway. Those 3 panels and posts have fallen over, so I'm now going to rip it all out and put in a new fence, and I'm going to claim that as a repair. No, that would be classified as a renovation because you're not replacing like with like. You've upgraded what you previously had. So, for example, the kitchen cupboards are getting a bit worn and tatty and need replacing, or they need some work. Okay, you shave them, you sand them back, you repaint them. Oh, it's a couple of doors that are a bit dodgy, so you throw them out, replace them like with like. That's a repair. If you look at it and see, gee, these cupboards are not worth my time and effort, I'm actually going to go and get a flat pack from a major hardware store and put that in place. That's a renovation. Okay, so that is the difference. So if you're looking at some major work on one of your investment properties, talk to your accountant about how that sits from a tax perspective, because the ATO's position is quite clear. If you're doing a repair, remember, like for like, those expenses are generally deductible. Okay, if you're upgrading or improving, then that's a renovation, and a lot of those costs will then become depreciable, particularly when you're starting to talk kitchen renos, bathroom renos, that sort of stuff. Okay, so make sure you talk to your accountant about the nature of the work that you intend doing and whether or not, in fact, it's deductible or depreciable, because that will make a huge difference on the accuracy of your tax return. So please make sure you get that right by all means. So in summary, what I've talked about today is being information only. It hasn't certainly been intended to be any sort of advice to you. If there's something that I've said that gels with you or rings an alarm bell with you or gives you something to explore, then go and speak to your advisor about that. All right, because they are the ones that are qualified. They're the ones that got the pieces of paper that say they can give you advice in those particular areas. Look, if you're finding that maybe your broker and or accountant are maybe struggling, or you think they are struggling a little bit, look, give us a tingle. We do have a number of brokers that we can recommend right across Australia, by the way. And also we've got a number of accountants or accountancy firms that we're more than happy to recommend to you also across in various parts of Australia. And can I say that in making those recommendations, there's no kickback, if you like, back to us. This is purely, we're making that recommendation because we've heard good reports about them, or in fact know people who've used them directly, or in fact may have used them directly ourselves. So that's pretty much how it works. If you want to talk anything along these lines or anything else, by all means give us a bell. There's our 1300 number. Either talk with Chris, and there's his mobile number, or my mobile number, Derek Jones, down the bottom here. Or conversely, if you're more of an email person, send us an email. But I've got to be honest with you, we'd prefer to talk to you. Much prefer to talk to you. Look, on that note, folks, that draws us to a close. As I say, I hope you got something out of it. As I say, don't hesitate, don't be a stranger, give us a call.